all-inclusive trust deed, AITD or RAP, land. These can all be considered notes for this presentation. Okay. In note trading or investing, there are essentially three categories of notes that have very different strategies. You have, as I said earlier, performing notes. What do you think of Finnie?
It's getting paid on time and everything's running smoothly.
Just like it says, the note that is performing. You're getting what the payer is doing what they have agreed to do, and the receiver is getting what they expected to get. It's performing. Non-performing notes, anybody, what would that be?
The opposite.
The opposite. There's a hiccup somewhere, right? Did Janice have any non-performing notes when she had the properties in Detroit?
Was non-performing.
She was
So were my
non-performing.
tenants.
So, and then you can have re-performing, which is essentially when you rehab the note or restructured it or in some way or fashion have been able to get it to re-perform again. It could be classed as a re-performer. Now, these have different values when you trade these notes. Performing notes obviously have the greatest value. And it's like credit, right? Non-performing notes, well, these have the lower value. Re-performing notes are somewhere in between. You know, they're a little bit suspect because the people who've been paying on them haven't made some payments, but now, right now, they're performing well, so they're somewhere in between. Performing notes are loans where the payer is current with their loan payments. Typically, when we discuss trading performing notes, we're referring to seller financed paper. What I mean by that is a seller financed note, otherwise known as a vendor take back or a private mortgage, would be if I was going to buy a property from Aaron and he's going to seller finance it to me. So I might give him a down payment and I'll give him a note for the balance of the loan. Okay. Now, he's originated this note, so it's not with a bank. There's no bank involved. It's him and I. Okay. So that's, and I take the property. He wasn't a lender that put it together. He actually owned the property and sold it to me. The vendor take back mortgage. Now, why would Aaron want to do this with me? What would be a reason somebody would want to get the interest rather than the full amount?
And he's not responsible for the property.
He's not responsible for the property. So he's now getting an income, but it's not like he's renting it, so he's still responsible for the property. He's collecting interest, so instead of selling it, taking that money and putting it somewhere, getting the interest, he's just getting the interest directly. Those are two really good reasons. What other reasons do you think there might be for a motivated seller to do that, or a seller to be motivated to do that?
Higher sale rate. Higher sale price.
Higher sale price. They can ask a premium, can't they? You know, if you're providing the financing and somebody maybe couldn't qualify for the financing, but they have a good income, maybe they're self-employed, maybe they have bad credit, but they got a good job. Any of those things can allow, you can ask for a premium because you're giving the financing with the property. So non-performing notes, so performing notes are typically seller financed, and the reason that is the banks don't trade those on the open market or the secondary market, right? Like the banks originate them and they get traded amongst the banks, okay, or they get bundled and collateralized and whatnot, securitized. Now, non-performing notes, these are the ones that in which there's a default, right? And they could be private mortgages or big bank mortgages. Now, we've seen a lot of bank mortgages become non-performing over the last 12 years. Since 12 years. Now these ones do tend to trickle down into what we call the secondary market, where the ordinary people like us can have an opportunity to buy these. And how that works typically is when the bank has a bunch of these, they're not performing, they'll bundle them together and they'll sell them to somebody like a hedge fund, private equity firm, somebody who specializes in that asset class. And those groups will take what they want to work with, because they have their parameters of what they like to work with, and they'll take the low-hanging fruit, the ones they want, and they'll sell the rest. So they just get bundled and cut, bundled and cut, and bundled and cut. And they get kind of trickle down to where we can buy them in the industry as individuals. We can buy them in 1, 2s, 3s, 10s, whatever. But keeping in mind, they've already, I mean, these are the culls, right? These are the least desirable ones, because the big boys have taken cherry pick the best. Now, as far as private mortgage, why would Aaron want to sell that mortgage? So he has the mortgage, I have the property. As a private, why would he want to sell that now? Whether it's performing or non-performing. His kid got into Stanford.
He needs college.
So he needs cash. It's a great idea, right? So at the time when we did the deal, he wanted the cash flow, right? He didn't have another place to put that money. But now things have changed. Now he wants a lump sum. So now he can go and sell that promise to pay. He can sell that income stream. He can sell that note for a lump sum. Now, is he going to get what we call the unpaid principal balance, whatever's owing on that note when he goes and sells it? Depends. It depends what the interest rate is. If that note was written at 15%, right? Because the person buying the property was really motivated, really loved the property, and he was really a sharp negotiator, and he got a 15% note, do you think somebody else would pay him face value to get that 15% return?
Yes.
Absolutely. In fact, he could probably sell that note for a premium in that situation. He could probably, there may be an outstanding balance of, let's call it $80,000, but he could probably sell that for 84 and give somebody 13%, right? Potentially. And that's what's beautiful about this space. There's no rule. I mean, it's yield. You don't talk about interest rates once you're dealing with notes. You're talking about yields. What is that yield going to be for me as an investor when I buy that note from you? So I love that about this. There's nothing more. I mean, real estate is so exciting in the sense that it's creative to begin with, right? Isn't that one of the most exciting things about it? There's so many ways to do a deal. There's so many ways to do anything in real estate. Well, when you actually get into the paper side of it, it's because it's only limited by your own creativity. I mean, it's the Wild West. You can do some really neat stuff in the note space. So that's why you may want to sell it, because he needs the cash. You may want to sell it because he can sell it for a premium because interest rates are low, and the note was originated at 15%. I mean, who was around in 1982? What were mortgages in 1982, Janice?
Oh, gosh.
19?
Yeah, 19%.
Well, I know 16. The first mortgage I ever had was 12.625. I remember that. It was awful.
My first mortgage was 11 and a half, but that was 90. That was 1990. Early 80s, it was in the high teens.
Yeah.
Unbelievable.
I refinanced from 12.625 to 10.12. I thought that was a real deal.
Speaking of, I want to mention regarding Janice's deal with college, that's a brilliant, guys, look into that. My first my first property I bought, I was a college student, and or half a duplex. In Canada, where I'm from, you can buy, like here you have to buy the whole duplex, right? They're divided. You can buy the one spot. The half duplex, there was a bedroom downstairs, and I reconfigured it and redid the kitchen downstairs, and I put 4 kids in there at $200 a bed, and made a basement. My mortgage was $780. My wife and I and our son lived upstairs while I went to school, so I made $20 a month renting to kids downstairs. That college students, that's the best way. Now I did have to pay the utilities, so it probably cost me $80 or $100 a month, but that is definitely a great play to be able to do the college housing that you're talking about. I love that. I digress, sorry. Why would a buyer want to buy a private mortgage note like the note that Aaron has?
He wants the cash flow.
Cash flow. He's got cash sitting there that maybe he can't get it to produce the same income he could if he bought Aaron's note, especially if it's 15 or 12%, right? There's a lot of different factors come into play between the buyers and the sellers. Aaron may have bought that note. Okay, this is a different note because that one he originated, but John may have bought a note that was a non-performing bank note, and because it was non-performing, he got it at a discount. And then he worked with the borrower and found out what's wrong, how come you quit paying, how can I help you get back on your feet? And he worked with them, and he put his own sweat equity into rehabbing that note and got that payer reperforming, okay? So now maybe it's a 10% note, and maybe he paid, we always talk in the note space, we talk yield and we talk percentage of value. So when you're buying on the percentage of the lower of the unpaid principal balance or the lower of the value of the property, okay?
So you talk yield, and what's the other one?
Percentage of value. But the value is divided into two different, the lower of the unpaid principal balance, the debt, or the property value. You can't have both. You get the lower of the two is where they trade, okay? So, John buys it at, it's non-performing, it's the first. Okay, and we're going to talk about the first and second, but the first is the senior lien, okay? It's the first, he buys it at 40 cents on the dollar. $100,000 loan, hasn't been performing for 4 years, he buys it for $40,000. Now he spends some time and energy working with the borrower, helping them get the strategy, getting them paying, informing them that he's not like the bank, he's not a big institution that's lost track of the note. He's a one-man shop or he's a small family business, and they put a lot of money out for this, and they're not going to lose it, and they're not going to pass it off to somebody else, because these notes will transfer from bank to bank to bank. Because if you recall when this happened, when the downturn happened, there was so much of this. The banks, I mean, they couldn't keep up. They still can't. There's still tons of orphan loans out there that the banks have just not kept on top of. So he says, look, I'm, Mr. Jones, I appreciate all you've been through and whatnot over the last 4 years, but I'm now the bank, and it's our own family business, and we've got to come to a resolution, or I'm going to have to foreclose. And so you get the guy to, you work with them for 6, 9, 10 months, and now you have a rehab note that you can sell for a premium. Now you may have bought it at 40 cents on the dollar. If it's 6 months plus, it could be trading at 80 cents. So it's a pretty big jump. Now, that's why someone would want to sell, because they've now done the work and created. So it's one reason someone would want to sell. And the reason somebody would want to buy is because they're still getting a 20% discount, right? They're buying at 80 cents, still getting a 20% discount. Again, quite often the notes that are trading at a higher interest rate, or the the coupon rate, the original loan rate is much higher than it is today. I mean, we're at historic low interest rates today, right? So a lot of these loans were written in 2000 through 2007. The interest rates were considerably higher. Does anybody have any questions? First and seconds. So first, that's the first position notes, otherwise known as the senior liens, okay? They have the rights to foreclose in the case of default. Okay, so there comes in line. The seconds, otherwise known as junior liens, are second position. Foreclose from second position. It's a bit of a misnomer for some people. You are not, you're still subject to the first lien. And that's kind of a fun thing that you can do, where you can buy a second that is much lower value. First off, it's a lower principal value, but also seconds because they're in second position, they're less desirable, they're less secure, they trade at a lower rate. So you can buy them at a bigger discount. But so many people don't realize that you could buy a second close on the property subject to the first, and now you can control the property at a discount. So a great example of that is, and I'm getting, I'm kind of getting off track with my presentation, but I just want to give you guys as many gems as I can, as many little hints and ideas as I can. For example, there's a loan that's $100,000. The borrower, or there's a $100,000 home, the borrower has put 5% down, they got 20 in, 75,000 in a first, okay? Because whatever reason they're falling behind, they fall behind on the second, not the first, okay? They gotta choose, what are they gonna pay? Well, we can almost make our mortgage, we can't make the second. They're junior, they're less likely, they're not gonna bug us. I don't wanna piss the first off. That's the one I don't wanna mess with, right? So they keep the first going, the first is happy. Bank of America has no idea that they're having a problem with the second. They fall behind on the second. Well, if you own the second, okay, so maybe that second has somehow gotten traded in the secondary market, you've ended up with it, and you want to foreclose on them, you can foreclose on them, go through the proper channels of a notice of default and a notice of trustee sale, and you can foreclose on that and take it back at auction. Now, you actually step into the position of the first. You can evict them because you now hold the deed. Now, you're subject to the first. You step into the position not as the first, of the homeowner. Okay? So you now had the debt as a second position note holder. Now you step in and now you control the property. Okay? So it could have been a property that just barely cash flowed if you were to rent it, if you had to pay the full price. You're in there and you can now cash flow the property and take over control. You could choose, you know what? I'm not suggesting you do this, but you could choose, you know what? I'm just gonna take a bunch of cash flow out of this deal and I'm gonna quit paying the first. And then you could continue to rent it out just for what you paid in the second. Kind of a dirty thing to do because you're messing with somebody else's credit because you're not on the line. The original borrower is. But there's just a tremendous amount of flexibility in the note investing space to be able to control from unique positions. You can control, actually the only thing that ranks higher than first position notes is HOA, well, in your taxes. And you can actually foreclose, you can buy HOA liens and foreclose and take control of properties from that position. It's really remarkable when you kind of think how you can control real estate, because really, I think, who was it said it's not what you own, it's what you control.
What you control. Well,
That's,
you don't want to own anything, but you want to control it.
yeah, own nothing,
Yeah,
control everything. That's right.
Yeah.
And that's the same thing in the note space. It's all about being able to control the asset. So first things first, performing notes, it's all about discounts, okay? So why are notes discounted? The present value is discounted to raise the return on investment for the buyer to match their criteria or their yield. Okay, so if you don't discount your note, it may not be very desirable for somebody else to buy. The seller is willing to take less than the face value in exchange for having the funds now to put their kid through Stanford, right? Than to have that monthly payment. Just like the lottery winner, you know, $20 million, but if you take it all now, it's 7, right? It's 20 million over 20 years, right? So you can't have your cake and eat it too. Notes are discounted because the buyer is willing to commit to receiving an income stream for the term of the note in exchange for their lump sum payment. So they're willing to put away this chunk of money that they've set aside. It makes sense, it pencils for them to put that much money into this income stream, otherwise known as their yield. So that's why notes are discounted or negotiated, for that matter, to where they are negotiated to. It all comes down to what the buyer and the sellers, what their goals are, what they want. And what determines a discount on a note? Again, we're talking about firsts here. So when you're talking about firsts, the most important thing is the collateral, is the actual real estate. That determines. If that's run down, that's going to affect the value of the note. If that's pristine, it's going to affect the value of the note. When you're underwriting notes to buy and you're buying first, you spend a lot of your time analyzing the real estate itself, okay? The other things you determine are the terms of the loan. Is there a balloon payment coming due where you know you've got somebody that's committed to pay off the balance in 3 years? That has more value than a 30-year note, right? The pay history. Has the borrower been paying on time for the last 7 years? Okay, if they have, they're probably going to pay on the next 7 years. So I'll take that risk and I'll buy that note and I'll consider it more valuable than one where someone's missed payments. The credit of a borrower, you know, credit's a tough one because it is such a game. But honestly, in this financial world we live in, it's a measure that's used. If the borrower is likely to have a good credit score, they've played by all the rules, they're likely, the probability of them continuing in that pattern and paying all their bills and paying your loan will be there as well. Again, it's a probability. Then it comes down to what the seller needs. Now these are really key. And what the buyer, because in real estate, it all comes down to negotiations, right? So, answer, I need X. And so I'm going for X. And a buyer's saying, I'm only willing to pay Y. Well, one of them's going to have to give, or the transaction's not going to happen, right? So there's so many factors, and that comes down to the individual. Aaron's got this son that's going to Stanford. It's more important for him to sleep at night knowing that his son's tuition's paid than it is to get absolute every penny out of that note he can. So he'll accept less. He just wants that dealt with. He sleeps better at night. Okay? So that's how the discounts are determined on first. I made the comment, the value of the collateral, and I'm sure I'll get into it a little later, but when you're dealing with second position notes, you're underwriting the borrower at a much greater weight than the asset. When you're dealing with the first, you're more concerned about the asset and the borrower, but the asset's where you're putting your money. The asset had better be worth what the note is, or more than what the note is, okay? creating notes. This is where I've had quite a bit of experience. I was telling Christine earlier this evening that I started my note investing business or experience by helping some friends out that bought a pool of REOs. Does everybody know what an REO is? A real estate owned property, otherwise known as bank owned. So a pool of properties, they bought 60 properties in 13 cities and 7 states, and they had an exit strategy just to flip them out. Unfortunately, they did not do their due diligence. They really were not prepared for what they bought, and they had problems with title and couldn't get the deal done, and then the downturn hit. They got stuck with them, and a year and a half later, they still had them, and they asked me to help them with it, and they knew that I had some interest in real estate, and I'd done some real estate investing, and I said, yeah, I'd take the project on. So I jumped in and learned about all these and figured out how to move this product, and some of it we sold, some of it was burned down and let go back to the county for taxes, all kinds of things. But most of it, we ended up seller financing. My thought was, a lot of this inventory had been sitting there for years, and a lot of it had been already damaged by, a lot of it's in the Midwest, most of it. So people would come in and they'd take the copper because they could get it. They could get money for the copper, they'd take the wiring and whatnot. So we just wanted to move this stuff along. So I'd go knock on the door of the people next door and say, what are you paying for rent? $500. Well, I'll tell you what, buy this house, I'll only charge you $250 a month. And you can save yourself $250, or you can put that $250 into the house. Yeah, I know you got to put a furnace in. I know you got to fix the plumbing, but look, how else are you going to get in the house you're going to be renting the rest of your life? So we started seller financing these properties to move them along and get rid of them. So that's one way, creating a note, seller financing, like Aaron did when he sold his home. An advantage to doing that, it could be a way to sell an otherwise hard to sell. Like the gentleman said there, sell for a premium. That's another reason to seller finance. I can sell it on the MLS and sell it for cash or with a loan and get my money out of escrow and here, but I get 15% more by seller financing. And that's because I don't need the lump sum right now. Sell it quickly. I was sitting with one of my colleagues the other day, and he had a property in Pennsylvania, I think. And he had a call, he had it on Facebook Marketplace, and we'd just been talking about a specific seller finance strategy, and he had a call on it, and right then he just came up with something real creative that tweaked it, that got the person's interest, and made a deal right then, sold the property, seller finance, took all the stress off him. He was having to travel something like 7 hours to go to this property from where he lived. It just was not worth his time. And he like more than tripled his money from what he paid for it when he bought it. So he was able to sell it quickly because he didn't have to go through a traditional sale process. I mean, he can close tomorrow when it's your own deal and you're not dealing with escrow, right? And another one we talked about, create passive income, as John had said, get the cash flow, but not have the responsibility of the house. I call them owners in training. Like if you're not doing a mortgage, if you're doing a contract for deed, which is what we often would do in the Midwest, it's like a mortgage in the sense that they're the owner in principle, but it's like when you buy a car, the local Honda dealer, the bank hangs on to the title until you make your last payment, right? So you don't have title when you have a contract for deed. You as the borrower, the homeowner, you don't hold the title, right? Because the lender is hanging on to the title until you make your last payment. That's the difference between a mortgage or a deed of trust and a note, okay? So just a different way of doing business. It's a lot easier to foreclose because you actually don't foreclose, you repossess. So you have to get a cancellation of land contract and repossess. So you can move people in and out. So if you have suspect purchasers and or if you're in New Jersey and New York and you have really horrible foreclosure laws that are going to wrap you up for 3 years, you may want to use a land contract, or otherwise known as a contract for deed. Anybody have any questions on that? I know I'm throwing a lot of terms at you and stuff, and I apologize if they don't make sense. Please just ask. Jen.
Just a clarifying point, not the question, but, so in states where the foreclosure laws make foreclosure take a long time, you usually do contract for deed, like Michigan, that's how I know about it. And then in a state where it's a shorter term to foreclose, you don't mind giving the deed
Texas.
and mortgage, yeah. But in a lot of the Midwest states where they have judicial foreclosure, it has to go to court instead of just selling at the courthouse steps. So if it has to go to court, it takes like a year or two. You're gonna do a contract for deed, because you don't want that owner to have the deed till they've paid everything.
Yeah. Make sense? Notes is a great exit strategy when you're selling property. I have what we've done right here. Here's one that we purchased. We purchased this in Columbus, Ohio. I believe it was. We paid $32,200 for it. We spent $17,300 on rehab. We took 5% down and financed the $83,125. So the amount we financed more than now the loan to you was 104%. Now this is back to what I talked to you about. Would I be able to sell that loan? Now I've originated this loan, I've created it, and now the property is worth $80,000 and the loan is $83 and $125. Who wants to buy that loan from me? No? Why not? You don't get as much as you lay out for it, right?
I mean, I'll pay you 80,000 for the note.
Okay, so you'll take it at a discount.
Right. I'll take it at the value of the house.
Okay.
Depending on it all depends on the market, how the market's going. If the market right now, if the trend is actually increasing, then I wouldn't mind paying the finance amount on that for the market value. So you gotta look at trends and how it's going, and the numbers will speak for itself.
Maybe. I think that's speculation because you're still speculating on the increase, but principally, I think if we talked earlier, depending on what the interest rate was, if it made sense, you might pay that because the interest rate was high enough that you're going to do better at that than putting 80,000 into something else. Maybe, but an investor, really, this is not a very attractive loan. And ask me how I know that. We found out the hard way. When we started originating loans, we were originating them at way too high a loan to value, and we were thinking we're just going to discount them at 50 cents on the dollar anyway. They'll still sell, but that's not the way investors think. I mean, now that I'm a much more sophisticated investor, I'm always analyzing and looking at loans to value and loans to cost. So what we actually did on this is we created a first and a second. So the market value is 80,000. We sold it. We took 5% down. The amount of finance was 83,125. So we created a first at 75% of the purchase price of 65,625. We created a second at 20% of the purchase price for 17,500. So now the loan to value 104. It's 80. Now, who's willing to buy that first from me at a loan to value of 82? You're a lot more interested. Why? You're protected, right? You have some spread. The loan to value is lower, okay? So we discount the note to yield, I apologize. Graphic is out. We discount the note to yield 13% to the investor, which was like a $13,000 discount at $52,062. okay? So not only did we offer it at a good loan to value at 82%, we incentivized the buyer by giving them a better yield, okay? The note was written at 10%, we dropped the price to give them the equivalent of 13% return on investment, meaning their yield's 13%, okay? So we were into it for $51,900 and we sold the first for $52,000, right? What does that property owe us? No, we sold the note for 52 and we'd only put 51,900 into the whole property. How much, what's our return on investment? So we got 52,000, we only paid 51,900. So now we've gotten all our money back out of the deal by selling the first at a discount. But wait, there's more. We got a deposit of 5%. So we've already made $162 plus our 5% deposit. We've made $4,500 on this deal already. Is there any more money in the deal for us? The second, they still got to make that payment. They got 20 years of making $154 a month. So this property doesn't owe us anything, and we've now created $4,500 paycheck and $154 a month.
You kept the second.
And we
For-
held
for
the
the-
second.
yeah.
I mean, eventually we sold it, but at the time, and that was when we finally learned how to do this right. We were first originating at 93 or 97% value. Nobody would buy them, and it was a disaster. And once we got this down, we were creating cash flow for ourselves, which is what we wanted, and creating a little bit of capital gain up front. It's just one way to do a deal. This is an example of how we did it. So, non-performing notes are loans that are in default because the homeowner stopped making
Amen.
payments. So why are they available?
People want cash.
People want cash, banks want cash. How do we get them? You buy them for pennies on the dollar, buy them at a discount. You find them in the secondary market, as we talked. They trickle down. Again, the banks aren't going to talk to you. You can't call the bank and say, I want to buy this note on this property. I mean, you might call a small credit union or a small regional branch and get that. You're not going to call a national bank to buy the note on 123 Main Street. You're not even going to call a national bank and say, I want to buy $40 million in notes. They're not going to deal with it. They're dealing in twice. And it goes from them to private equity or hedge funds on down, buying them for tens and 20s and hundreds of thousands of dollars. How do we get them? What should we pay for them? And well, what we do when what does the banks do when a borrower stops paying? The asset stops producing, but it's still an asset on the balance sheet, right? So the bank has the options of either foreclose at the sheriff or trustee sale, whether it be judiciary or non-judiciary, foreclose and take back the property. So foreclose and sell, meaning somebody sticks up their hand and says, I'll buy that property at whatever price the bank is willing to let it go for at the sale. Often the bank won't reduce the unpaid principal balance, so they'll be asking more than it's worth, and nobody will stick up their hand and buy it at the auction. When that happens, it becomes an REO. It's otherwise known as bank owned, or they've taken it back. It's gone back to the beneficiary. Now it becomes part of their REO portfolio. My son works for Goldman Sachs in Dallas in their REO department. He sees this all the time. So now it's his job to analyze these and figure out what they're going to do with them, how they're going to price them, if they're going to do any work on them, and so on and so forth, and how they're going to sell them. Or the bank could say, look, but we're gonna take it off the auction block. We'll sell the note. There's a lot of that has gone on too, because back in 2010, 11, 12, you think the bank had a great reputation? No, everybody was hating on the bank because it foreclosed on. There's a period there where a lot of foreclosed. And it depends. It goes through cycles. Sometimes there's lots of notes being traded. Sometimes there isn't. Right now, you don't see much for REOs, do you? I mean, most of that has to do with our market because we're now recovered. Again, I said if the bank is an asset or a liability to the bank, it's a liability, right? The liability because it's not a loan. It's limiting. It is not a loan, and it's now limiting the amount of money they can lend out. It's on the wrong side of their balance sheet. Not only that, they're not a liability like a deposit account because it is illiquid and cripples the bank's ability to money multiplier. And then in addition, these toxic assets expose the bank to a great deal of other liability, insurance risk, these types of things. If you're gonna slip and fall on the ice in Wisconsin, do it on a bank property, not on Christine Springs. How NPNs, non-performing notes, are sold, otherwise known as traded. The banks sell them to hedge funds in large chunks. Hedge funds sell them to smaller bulk pools, or other private equity. Just trickles down to where we can get into mini pools or one-offs. What do you expect to pay for these notes? Okay, so we are familiar with real estate. We know how to evaluate real estate. And you can look and say, Zillow says, Zestimate this, that's gotta be what it's worth, right? Oh, don't ever record me saying that. No, but you can analyze Redfin, Zillow, wherever truly, and say, this property sold for this property sold for that, this property has same square footage, this is in this condition, yada, yada. You can analyze that. You can figure out, without being a mortgage appraiser, thank you. Why did I? Without being a mortgage appraiser, or or even just a broker, getting a broker price opinion, you can figure that out just as an experienced real estate investor. You can do the same with notes. It's just different rules. Okay, it's a lot more analyzing numbers. You got to look at a bunch of different factors. So the value is going to depend on the value of the asset again. For first, definitely the value of the asset, the location of the asset. Okay, is it in an area where, is it in San Diego, where we've got a really strong economy, and even if there is a downturn in the national economy, San Diego's really set to stay pretty strong. Other areas might be, they may be really heavy in one sector, and if there's a downturn in that sector, the market's going to change. So you got to look at all kinds of different things. The amount of the unpaid principal balance, the equity or lack thereof, outstanding taxes, and the pay history. Again, pay history is less important on this one than the value of the asset, but it still plays a role. And you always want to watch out for any kind of weed abatement or county fines and outstanding taxes. These things will bite you in the butt, especially if you're in like Chicago. Okay, you're in Clark County, and their rates are outrageous for 10 note, and you're thinking you're all good, but you don't check the outstanding tax, and you got 4 years taxes behind. It could be worth more than the house. I mean, it's crazy. So what do you do with these NPNs? Well, you get the asset, now you play the bank. You can either foreclose, or you can do something that's a little more creative and a little more interesting. It's called a deed in lieu of foreclosure. Actually, tomorrow, I'm going up to Modesto and meeting with, we're buying a property up there, and we're actually, my partner actually holds the note on it. The property's been been abandoned, and we're going to the homeowner, so we can either foreclose on these people, or you can go to them and say, let's just, here's $100, here's $300, whatever. Just sign this deed in lieu of foreclosure. I won't chase after you for what's outstanding. Just wipe this from your slate, and then I don't have to go through any of the expense or time of foreclosing, which would take him some time. So that's actually something we're doing we're driving up, but we're doing that on Saturday. So you get a deed in lieu of foreclosure. That's often the easiest way to do it. Now, unfortunately, I can't tell you how many times I've picked up the phone, I've tracked down the borrower in another city. They've already abandoned the property or whatever. They have no emotional tie to it. They've forgotten it, but they're still wondering, is somebody going to come knocking on the door asking for the money, because they still owe that debt, right? They're still in default on that asset, okay? I can't tell you how many times I've called them and had them on the phone and said, you know what? I'll tell you what, I'll cut you a deal. I'll give you $300, sign this over, it makes my life easier, and I'm gonna wipe you off it. You're not gonna have to worry about me knocking on your door. The debt will be forgiven, it's over. They're not gonna get 1099 for the deficiency, the difference between what what I paid for it and what you owed, So they're all happy with that until they talk to their brother-in-law's uncle, who happens to be a real estate agent, and put some garbage in their head, and now they dig their heels in and say, I want $3,000. It's like, you want $3,000 so I can alleviate you of your responsibility to pay me back? It's crazy. So I give them $1,000. But that's what you got to do. It makes it so much easier. Time is money. You don't want to mess with it. You get a deed in lieu of foreclosure as fast as you can. It's the preferred route to go. That's if they vacated the home. If they're in the home, I don't advocate buying notes to kick people out of their homes. It's not the way I do business. If I'm buying a note on a property and it's vacant, I'm buying it because I want to get a discount on that property. I want to end up with the asset. If I'm buying a note on a property because it's occupied, it's because I want that income stream. Okay?
Can you actually do that in every state?
Every state. Okay. So, again, I buy depending on what I look for notes depending on what my strategy is. Am I looking for assets, or am I looking for cash flow? Or I look at what I'm way. I get a lot of opportunities coming my way. That interests me because I'm looking for this time and get this time discount. See, I'll go that route. Once you buy something that's occupied, you make it a reperformer. You do a workout. You guys have probably all heard of loan mods, where the banks were doing modifications. You're essentially doing the same thing. You're taking and putting the payments to the back, right? Or you're forgiving payments. I mean, look, $100,000 loan, I bought it for $40,000, or John bought it for $40,000. Can he afford to give up a little bit to get the people performing so he can get $80,000 for it? Sure he can. He can cut him a little slack. Now, I'm of the opinion that I don't like to forgive the debt. I would put the debt on the back. I would wipe penalties and stuff like that. But if somebody signed on the line for the debt, I want them to pay that debt. That's just my personal opinion. I'd add that to the back of the loan. But when you do this, it allows you to build equity and realize the greatest gain with the least expense. Now, once a loan is seasoned, that reperformer will bring almost as much as a performing loan. Pension funds love reperforming loans. They love them, and they pay top dollar for them. Now, you can sell it. You can broker it or flip a note. John.
How long is the season? 1 year, 2 years?
That's interesting. It depends on the market. Right now, 6 months to a year, you'll get almost top dollar per season. 5 years ago, you would have needed a year and a half.
And you would just sell it to another investor, or you said who else would purchase them?
Here's
Hedge funds and stuff.
Well,
You know, it's getting
It's not, you don't even have to look, sorry, what's your name?
Justin.
Justin, you don't even have to look really that far away. We all know people that have IRAs that are yield starved, that are getting less than 6%, right? And if you can offer them an investment